Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown, along with my co-hosts, Mark Humph and Nam Phan of Pacific Private Money. Our phone number is 888-912-1190. Use that number to answer the trivia questions for a 5-pack tanning certificate given away during this show. That certificate's not sponsored by the radio station, but by Tannabella Tanning Salon with 2 locations in San Francisco and 1 in Marin. Today's trivia theme is entertainment. Mark, you got a lot of good stuff for us.
Including entertainment, yeah.
So,
you guys have been hearing for years that the trend toward home sizes has been moving downward. Remember, there was this trend toward McMansions in the 90s and early 2000s, and it seems like the last 10 years during this particular housing recovery, the trend has been moving towards smaller and more efficient spaces. Well, guess what? Homeowners are now telling their agents, if you can believe a number of articles that where agents are being interviewed about what their clients want, that they hate their homes. And not only that, they want out now. So, basically homeowners have become more intimately aware of the inadequacies of their space. Agents are noticing a dramatic rise in buyer urgency as well, where before they were saying, I'm going to be ready to move up in maybe a year or two, to all of a sudden saying now, what can I buy now? What's available now?
And I'm going to throw something in here. I'll bet some of this, if not all of it, has to do with COVID and being,
well, of course,
absolutely, with your wife and kids and going, we don't have enough space.
Yeah. Well, it's there's a number of interesting quotes here. I need to get out of my space. I'm going insane. Essentially, real estate agents are saying that the quarantine has convinced homeowners that they need more rooms, a backyard, plenty of kitchen space, and they want it sooner rather than later. There's also a general belief that these work from home orders for many companies are going to become semi-permanent. So more and more people, the whole working from home thing for the next several years. And buyers are homeowners rather, are realizing that they don't have enough comfortable space. So this is really interesting, and this is going to have, I'm going to share some other stories with you as the show goes on about, predictions from like Zillow and CoreLogic about where home prices are going, and what's happening with the selling season, and then the unemployment numbers. Now we're recording this show on Thursday, and it's broadcast on Saturday. Well, on Friday, tomorrow, they're announcing the unemployment numbers, and they're going to be ghastly. And so there's going to be a lot of reaction to that. But we're going to talk a little bit later in the show about how those horrific unemployment numbers are actually a little bit misleading. And then you got this whole dynamic now of you got California with low inventory. We haven't been building new homes. We have a bigger population today than we did 10 years ago. And now we've got this pandemic thing where people are stuck at home and they're saying, I don't like my house. I want to move up. I want more space. So all of these are going to be a factor in, I believe, an interesting and probably unexpectedly healthy, if I might predict, housing market in California. And I will admit that anybody who reads what I write and blog, whether it's on LinkedIn or our website or listen to me on this radio show, know that I have a habit of beating the drum as a real estate optimist. And I promise, or I swear, I'm not the National Association of Realtors. I'm not paid by them to go out there and go, rah, rah, real estate, it never goes down. But there's just a lot happening at the same time here that, if you step back and you look at these things, these outliers, like this very issue of, well, how are people feeling about the homes they live in today now that they've had to stay there for the last 3 months, and people are going, I want a home office. I want more space. I want a backyard. I want my own Shangri-La, because guess what? This is probably not the last time this is going to happen in our lifetimes, right? So between the fires and the losing electricity and having to, just the whole having to stay in your home and being comfortable in your home, things like electric power and solar, and there's just a lot of things going on that are impacting the way people want to live. And so
let me ask you something then. What happens to the houses at the smaller level then? because the people that you're
Well,
talking about are going from smaller to bigger.
well, there's always demand for smaller homes because don't forget entry-level people. Whether
Right.
you're single and you don't want to pay rent because you happen to believe that owning your own home is better than renting, and you're living by yourself, a small home is fine. Or a young couple getting started who don't have a family yet. But it's those with families where I think the togetherness, or people with small yards. Now you hear your neighbor's dog all day long, or the kids playing in the backyard, and maybe it's annoying for you. I mean, who knows? It's just the smaller lots, the close proximity. It's a very interesting dynamic.
It's also interesting that when 2008-9 hit, that a lot of the millennials were seeing their parents kind of go through this process of losing their house, and they were not buying; they were strictly renting. That seems to kind of turned a little bit, doesn't it?
Yeah, but now, there's an article that I'll refer to in another segment where it talks about rental rates going down year over year and how drastic of a drop it is. So a lot of what's going on is acute. And usually these are trends that take years to develop, but it's like overnight. So like, what do home builders do who are building inventory right now that may be too small for people's preferences because of the shelter in place? But we can talk about that. There's a lot to talk about.
Yeah, more to come in the next segment. We got some good stuff to talk about here.
Very good. And let's see, next segment, if we can get into that one or the one after, we will talk about the risks of investing in deeds of trust, because that's the main part of your guys' business. And I want to make a mention here also for Mountain Mike's Pizza. They are still delivering during this shelter in place. What better way than to get a beautiful, excellent tasting pizza in San Rafael from Mountain Mike's Pizza. Check them out. All right, we're going to cut to our first commercial break here. We're talking about entertainment. First trivia question. What was Aerosmith's first top 10 song on the Billboard charts?
Ooh.
Call 888-912-1190. First caller with the correct answer is going to win that tanning certificate. All right, stay with us. You are listening to The Best of Investing, and we are going to be right back. Welcome back to The Best of Investing. Again, I'm Edward Brown, your host, along with Mark Hunt and Nam Phan of Pacific Private Money. First trivia question. What was Aerosmith's first top 10 song on the Billboard charts?
Was it Walk This Way?
Nah, Dream On. Dream On!
That's it.
There we go. Okay.
Hey, that was good.
So, Mark, go ahead and share with us some other
Continue on. So the next article I want to talk about is, Zillow, they employ a lot of economists, and many of those economists are pretty avid posters on the media. And so one of the blog posts that caught my eye had to do with the traditional spring selling season, which we're right in the middle of right now, which because thanks to the virus, not as many people are putting their home on the market. There's not as many transactions. You're obviously seeing headlines about this huge dip in sales. I mean, sales are way, way down so far this year as a result. So what does that mean for the selling season? And so Zillow did a survey of more than 100 economists, investment strategists, and real estate experts, asking them how they thought the sales would look over the next 12 months. And I thought it was pretty interesting. There was the school of thought that said, well, the spring selling season is going to be pushed into the fall. But only about 10% of those surveyed thought that was true. And I know that some of the problems about selling your home in the fall is that if you have children and they're going to school, you want to get that all taken care of before the summer. So only 10% of people thought that was true.
Well, what about kids going to, what about the shelter in place? Hopefully the kids will still be at home.
Well, that's right. So you're right. We still may have a couple more months of this. So pushing the selling season in the fall, maybe. There will be transactions in the fall. But and again, I'm talking about those who were surveyed. 22% of those surveyed thought that they would expect a doubling up of next season, and that's pretty interesting.
Yeah,
and again, if there is a pent up demand that comes out in next year, say February, March, you could be looking at upward pricing pressure again on especially in California, maybe not in other parts of the country. 55% now said the shopping season will be spread out over several years. So a little bit more than half thought that, this whole demand would be pushed forward, and 13% said, what?
Well, yeah. Yesterday I actually talked to a real estate agent who said that I don't want to say it's a frenzy, but there's still some over bidding on houses, and he sold 6 houses last month.
Wow. Where in here in Marin?
Yeah, in Marin and the East Bay.
That's interesting. Okay.
Yeah. So anyway, the predictions on how the housing sales cycle will look over the next year, this Zillow economist is saying that this prediction is in line with how the experts expect the U.S. economy to recover overall. 40% think it's going to be a U-shaped recovery, and 33% think it's going to be a bumpy multi-year return to a growth trend. So very interesting. And again, a lot of these articles that we talk about are nationwide in scope. But here in the Bay Area, here in California, where we live and where we invest and where we place investor capital at Pacific Private Money, we're mostly concerned about what's happening in basically the 5th largest country on the planet, which is California, if it were a country. And so
it sort of is.
It's going to be interesting. I think the metrics and dynamics for housing and real estate valuations, and those who invest in real estate secured mortgage-backed products, like those who invest with Pacific Private Money, I think there's just a lot to be optimistic about, regardless of the headlines. And we're going to see the headlines. Headlines are going to come out. Housing prices fall.
Right.
Those headlines. Sales down 20% year over year. In fact, both CoreLogic and Zillow, in separate articles this week, said they expect home prices in the next 12 months to decline. Yeah, but that's nationwide, and that's all over the U.S. I don't know that I believe that that's going to happen very much in California. Although certain parts of California, which include the city of San Francisco and Silicon Valley, it wouldn't surprise me if there was a 5% drop in prices year over year, because those price per square foot in those markets are, in my opinion, much higher than unreasonably higher than many other neighborhoods and MSAs in California. So again, very, very interesting dynamics at play here.
Yeah, and if I can add to that too, kind of tying into the first segment is, as people want larger spaces, I could see why or how they may choose to exit San Francisco, especially if they're able to work remotely. But the question is, if I'm, like, for instance, Twitter came out and they said all their employees can work remotely indefinitely. Mm-hmm. But if I'm an employee at Twitter, do I move? I might go, okay, great, I want a bigger place too, and I can get more for my money elsewhere. But do I move to, Sonoma County, or do I move out of state? My guess is that I would move to Sonoma County, because how long am I going to stay with Twitter? Yeah. If my job is tech related, I probably want to stay too close to the epicenter of it. So I don't think there's going to be a flock or a mass migration out of state, but I think people will move into the burbs.
Absolutely.
Like North Marin, and so you may see home prices go up because people with higher incomes are now moving into Sonoma County or Marin, and you may see some price drops in places like San Francisco or the Silicon Valley.
Well, you're seeing the rent. So it made headlines that rents are down 10% in both Silicon Valley and San Francisco, which, interestingly enough, are where you have the highest prices per square foot on the resale side this past, several years. And that actually surprised me a little bit, that that rents would drop. But I think we all know that rents from San Francisco to San Jose have been extremely steep, and we've all seen the articles, a year ago this summer, or a year ago last summer rather, the ridiculous articles about how much people were paying for, what essentially was a closet with a mattress on the floor, for $1,000 a month or something. So not really surprising that there's a little bit of a pullback there on the rents and likely on the prices as well.
It kind of makes you wonder if people who sheltered in place decided to leave, who were living in San Francisco, decided to leave San Francisco completely while they sheltered in place and moved back in with their parents, moved out of state. So that's where maybe they're deciding not to come back.
Hopefully this looting situation will end very quickly. I guess once they clear out stores, there's nothing else to steal. So hopefully that'll those opportunistic people will stop. Okay, guys, going on to our second trivia question here, talking entertainment. What was the name of the high school in the movie Grease? What was the name of the high school? All right, call 888-912-1190. Remember that was with Olivia Newton-John and John Travolta, right?
Oh, yeah.
All right.
I had the soundtrack.
Oh, yeah, I know. It's good. It's good music. I like it, actually. What was the name of the high school in the movie Grease? Call 888-912-1190. First caller with the correct answer is going to win the tanning certificate. Stay with us. You are listening to The Best of Investing. We're going to be right back. Welcome back to The Best of Investing one more time. I'm Edward Brown, your host, along with Mark Hunt and Nam Phan of Pacific Private Money. Second trivia question. What was the name of the high school in the movie Grease?
Rydell.
Rydell High. Very good.
We used to call Olivia Newton-John Olivia Neutron Bomb because
right. Yeah.
She was the bomb.
She was the bomb, I'll tell you. Hey, Mark, you have some unemployment figures for us.
Yeah, so the last article I'm going to share before we dive into some other things today have to do with unemployment statistics, and I found a rather interesting read this week. And actually this came out today on the day, Thursday, that we're recording the show. It says tomorrow morning, the Bureau of Labor Statistics will release the latest employment situation summary, which will include the most current unemployment rate. It will be a horrific number. Many analysts believe unemployment could be greater than 20%. These numbers represent families across the nation that are not sure when or if they will return to work. The emotional impact on these households is, of course, devastating. It goes on to say that there are, however, some small rays of light shining through on this issue, and here are three of them. Number one, the actual number of unemployed is less than they are reporting. The number of people unemployed is sometimes over-exaggerated. It seems that every newscaster likes to talk about the 40-plus million people currently unemployed. It is true that over the last 10 weeks, over 40 million people have applied for unemployment, but it is also true, however, that many of these people have already returned to work. The actual number of people currently unemployed today, according to this article, is 20 million. Still a horrible number, but about half of what's being reported. And again, you got to keep what you hear on the media with a grain of salt. Number two, of those still unemployed, most are temporary layoffs. Last month's unemployment report showed that 90% of those unemployed believe their status is temporary. And then number three, and this is the one that I think is the most important, those on unemployment are receiving significant assistance. According to a recent study from an Institute for Economics, 68% of those who are eligible for unemployment insurance receive benefits that exceed their lost earnings. That's 68, let's call it 70%, are receiving unemployment checks, benefits that exceed their lost earnings, and 20% are receiving at least twice as much as their lost earnings.
So where's the incentive?
We've heard these stories, Edward, you probably heard these too, where where employers got PPP money from the government to use for rehiring their staff, and a lot of them didn't want to come back because they would take a pay cut from their unemployment benefits. So again, this is not to downplay and poo-poo the whole unemployment thing, but when people say to me, hey, Mark, you're so optimistic about real estate and prices and all that, I still have investors who are convinced real estate prices are going to drop 30%. I think they're completely crazy and unjustified, but they say, what about unemployment? What about all the unemployment? If people aren't employed, they can't pay rent or buy houses. Well, yeah, but you got to know kind of what's the reality behind it.
I don't know. If anything, they're getting more money than they were getting before when they were working. They can afford more homes. So what do you
Yeah.
do?
So again, there's always
How about
there's always the story behind the story, and that's the stuff that we try to bring you here on our radio show. It's just to look at it another way. We all know the media is paid to scare you and grab your eyeballs, and so in fact, I learned years ago that the headlines are never written by the guy who wrote the article.
Right.
So oftentimes the headline belies what's actually in the article itself, which is why you have to read the article, not look at the headline and go, "Oh my God, we're all going to hell."
So, I don't know if we know the answer here, but for the unemployment report, is that new claims or is it net job growth or negative job growth? It's just new claims.
I think it's people who have applied. So
Okay,
it's gonna be a larger figure than it really should be.
Yeah, they're saying 41 million people will have applied for unemployment, but currently unemployed is 20 million. And of that number, a lot of them are going back to work.
Right.
And many of them are earning money exceeding their prior earnings. So again, and if they're not making their mortgage payments, in theory, some of these guys might actually be building up a little bit of stockpile. So again, there's a lot going on right now out there that thanks to government assistance.
So when
we don't know about.
when Mr. Unemployed goes to the bank because he wants to buy a house, and they say, "Well, what do you do for a living?" He goes, "Well, I'm unemployed." They go, "Absolutely fantastic. We're going to give you a loan. You're making more money."
Right. I mean, because so it seems like we're sort of at the point where a lot of the country is moving into like latter stages of, of stage 2 or later stage 2. With each one of those stages, how many people are going back to work? It's a lot. So,
well, you guys haven't stopped working because you're an essential service.
But traffic is significantly up on the freeways.
And retail opening back up brings a lot of people back into the actual workforce again. So. It feels like we're at that point where people are going back to work more than they are actually getting laid off, or unemployed. So I don't know. I'm an optimist as well. So it'll be interesting to see what happens over the next with the labor report.
Right, and we're looking at our own loan portfolio, and there was that initial scare of borrowers who requested deferments, but that number hasn't gone up for us. And I've talked to other loan originators, and it hasn't gone up for them either. It's been very manageable. Now, there are, banks and other institutions and servicers that are in a pickle because they weren't prepared for the situation of, say, 10% or 5%, whatever that number is, of their borrowers not making their payments, and how that affects where they get their capital from. But for companies like ours, it could have been a lot worse, and that for that we're pretty grateful.
All right, guys, we're going to come to our third commercial trivia question here, and when we come back, we've got an email question that asks, "What are the risks of investing in Deeds of Trust?" That's a point-blank question. All right, what was the name of the cook on the TV show Bonanza? Call 888-912-1190. First caller with correct answer is going to win that tanning certificate. We're talking, this is a show from the early 60s.
I think our listeners are really old.
What was the name of the cook on the TV show Bonanza? Well, they're still doing reruns now, so you can watch it, all right? So that's our trivia question. When we also come back, we're going to have Nam and Mark share a deal of the week, so you can educate the public as to investing in Deeds of Trust. All right, sit with us.
Yeah, I'm looking forward to answering the question about the Deeds of Trust and mortgage investing in general, and why you should be bullish in that area.
All right, stay with us. Don't touch that dial. Best of Investing will be right back.
Roll right in.
Welcome back to the Best of Investing. Edward Brown here, along with Mark Hanf and Nam Phan. Hey, by the way, you know what? We haven't said this for a while. People ask, well, what's your show about? Oh, it's like a bunch of guys sitting around a bar having drinks, without the drinks, talking business, mostly real estate, and the audience listening in. So that's kind of the format here. All right, here was our third trivia question. What was the name of the cook on the TV show Bonanza?
Cookie?
No, Hop Sing.
Hop Sing.
Hop Sing.
That's right.
Okay.
Jeez.
What's the origin of that name?
Yeah.
Anyway.
He was from China. Okay, so guys, a question comes in from a listener. It says, what are the risks of investing in deeds of trust?
So I'm going to expand on the answer to that question. So interestingly enough, we're in a business at Pacific Private Money where we make loans to people who are buying real estate, who own real estate, looking to pull cash out. We're one of those companies that you go to when bank financing is not an option. We're usually plan B, although oftentimes we're plan A for people who just know they can't get bank financing because they have to close quickly, or they're self-employed and they have trouble proving their income. But the kind of loans we make and the kind of loans that most private money or hard money loan originators in California that we know of make are not hard money loans from, say, 20 or 25 years ago that people oftentimes remember. The lender of last resort, the guy that you pay 12% interest and 10 points for a $100,000 loan secured in junior position on your home. Basically when you have a personal financial emergency or some kind of personal financial distress, you go to a hard money lender. If you own a home, you can borrow against the equity in your home. That was very, very traditional hard money, and a lot of the hard money loans made in the 90s and early 2000s they were either development type of loans and speculative type of loans, or they were junior liens on people's homes because they had a financial situation that they needed to take care of, divorce, lawsuits, who knows what. Fast forward to today, and the term hard money lending isn't even really used anymore. It's private money financing, it's alternative financing, and it's really the third leg in a trio of borrowing options for people who are buying real estate, doing refinancing on real estate. And the first leg is bank financing. The second leg is your non-agency or non-QM financing. That's a little bit more expensive than bank financing. And then there's your private or alternative financing. It used to be called hard money, and that's where you pay anywhere from 8 to 10% for the money. But we're generally not making junior liens on people's homes unless they're using it to remodel their home to sell. I mean, we're not that lender of last resort serving that distressed borrower. It's really a strategic need that we're filling. It's a need for speed. It's a need for certainty when you're self-employed and the bank's saying, looks like you don't make any money according to your tax returns. So it's all of those reasons that all of a sudden we're a solid plan B or plan C for a lot of folks who are investing in real estate or own real estate, and they're looking for options. So with that backdrop, we make loans that to people that really need to have some kind of solid exit strategy. We don't make loans to people who are just going to keep that loan forever and ever and struggle to figure out, now how am I going to pay that back. We make loans to people who are going to do one of two things. They're either with certainty going to sell their home, and we're lending them to them on the promise that they're going to sell their home to pay us back, or we're helping them buy a home and we've already ascertained that they're bank financeable. So short-term loans, we have a high degree of certainty we're going to get the money back. So, and we charge anywhere from 8 to 10%. And our investors who provide the money for those loans are getting returns usually about 1% below the note rate that we charge. And so when someone asks, what's the risk of investing in a deed of trust? Well, the risk is that, do you believe, how likely is it that the real estate values will go down so far that your 70% or 65% or 60% loan to value, loan to today's value mortgage is going to be underwater? And yeah, it happened in 2008 and 9, but is that likely to happen now? Well, based on the things we always talk about here at the Best of Investing, we don't think so in the coming years. We think the loans we make today are extremely well secured. And so really what you have in terms of risk is, what if the borrower stops making payments? Well, that does happen. We have people, of the 300 loans we're servicing here at Pacific Private Money, we've got probably 20 or 30 people that are 1 or 2 months behind. It kind of goes with the territory. Sometimes they don't pay for a few months and they play catch up. So, if you're making an investment in a deed of trust because you're relying on monthly income, well, it should be relied upon as additional income or a diversification of your income creating investments, but you probably don't want to rely on it such that if the borrower fails to make the payment, now you're not able to buy groceries. But beside that, the risk of loss, I think, is fairly manageable. And in investing in California secured deeds of trust, we believe very strongly that the economics behind them and the safety and security factors of a 60, 65, 70% loan to value mortgage are such that they're just the risks are just really small. The biggest risk is that they stop making payments. You have to file a notice of default, foreclose on the property. Maybe the borrower files for bankruptcy, and now it takes you maybe 6 months before you end up foreclosing on the property and get your money back. But when that happens, oftentimes you make a bonus. You make some additional interest income and late charges. So I'm really bullish on it. I mean, the three of us here, we're very big on investing in mortgage-backed products. It's what we provide as investment options at Pacific Private Money. I know where all my money is invested, and I know you shouldn't have all your eggs in one basket, but we have a lot of baskets.
Yeah.
We have a lot of diversified investment opportunities at Pacific Private Money, including individual deeds of trust and 3 different funds that invest in different types of real estate notes that make different mortgages, and they each provide different returns. And so for more information, you really should visit our website. We just updated our investor tab to show the 4 ways to invest with Pacific Private Money, and that's at pacificprivatemoney.com. That's pacificprivatemoney.com. Go check it out and hop on over to the investor page. We will have some individual landing pages for each of those 4 methods in the coming weeks. We'll talk about that more. But there just isn't, in our opinion, any better way with the similar safety and security features to earn 7 to 8 to 9% annualized yields on your money with protection for your principal.
Very good.
You can call us too at 415-883-2150. That's my contribution.
And are you guys having an event coming up pretty soon?
Yeah, June 23rd, Tuesday at 5 p.m. You can go to our website to the events page. It will be a webinar. Last one we had was April 16th. So we're due for another one. A lot has happened since then.
Very good. All right, stay with us. You're listening to the Best of Investing. When we come back, we're going to have some closing comments.
Perfect.
Yes.
Welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, along with Mark Hanf and Nam Phan of Pacific Private Money. No trivia question, but Nam, give us a deal of the week, if you would, please.
Yeah, deal of the week. So this week, or it was last week, we had a homeowner who, I'll describe it, they have a home to sell and they wanted to purchase before they sell their current property. So that's a very familiar scenario that we get, and normally, we would say, great, we just close another bridge loan. We provided the capital for the homeowner to buy their new home, cross-collateralizing against their departing residence. But in this case, the borrower wasn't the homeowner, it was a real estate company. So the real estate company in this case said, listen, we will buy the home that you want to move into for you. And what we'll do is we'll rent it back to you for a short period of time. We'll list the home that you need to sell, and then we will, when your home sells, you can use those proceeds to pay us back, or pay us off, or get a conventional loan. In the meantime, you have the surety of getting your offer accepted because we will be making the offer on your behalf, and then you don't have to worry about a double escrow or getting a bridge loan per se. So in this case, the real estate company is borrowing the money from us, and we're seeing more of this. They realize the same problem that we realize, that with many homeowners that have a ton of equity and are stuck in a situation where they normally would have to sell their home first in order to get the cash out to buy their next home. So in this case, the borrower is the real estate company. We're talking to a lot of real estate companies now who want to provide this service, because really it's a service that makes it easier for them to get the purchase and the sale once they sell their listing. So it's not unlike other scenarios that we've done in the past. It's just that the borrower in this case is the real estate company, and everyone wins in this situation. The homeowner gets to move into their next home, and they don't have the stress of moving twice. And they also are working with a great real estate company that can help them with both purchase and sale. I don't know if that real estate company offers a sort of a freshen up program, but you're seeing more real estate companies offering these types of programs as well. So
yeah, it's interesting. I was talking to a newspaper ad rep who's familiar with what we do, because we're going to do some display advertising in one of the local periodicals, and she said, "Oh yeah, I know a lot of Compass and Golden Gate, Sotheby's agents who offer that themselves. Is yours similar?" And I said, "Well, you want to know a secret? Those agents are coming to us for the bridge financing. We're just not on their website. They have other resources, but right now a lot of those resources are not providing bridge loans. They're not providing cross-collateralized loans, so they end up at our doorstep, or companies like ours, which actually there's not that many companies in California on the private lending side that are doing owner-occupied purchase money bridge financing. And so that's a really unique product that we're pretty proud of and we're pretty excited about. And we spend a lot of energy informing real estate agents and mortgage professionals that this is a viable and important product. It's a tool that they need to be aware of and keep it in their arsenal, because even though on the face of it, it seems like, well, borrowing $1 million at 9%, that's crazy talk. Well, yeah, but that's an annualized interest rate on a loan that you're probably not going to have for more than 90 days. In fact, the average payoff is 3 months, 3 to 4 months.
Not only that, but you can make the realtor can make an aggressive offer, because you can close so quickly that it actually can save the buyer thousands of dollars, which it has.
Well, we do say that, we can't promise it, but using our bridge loan as opposed to selling first and moving twice can oftentimes pay for itself, allowing you to move out, freshen up, stage your home, sell it for a higher price than you would have had you tried to sell it while you were still living there. So again, for more information, give us a call. We're experts on this type of stuff. Go to pacificprivatemoney.com.
Very good. All right, guys, thoughts for the day. Winners don't wait for chances. They take them. And losers quit when they're tired. Winners quit when they're done. And since we're done, I guess we're winners. All right, tune in next week. We're going to be giving away more free prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown. We're wishing you the best of investing. So long.